Hello students and welcome to the model 5. Today we'll discuss the topic called as anti-takeover strategies. So what are these anti-takeover strategies, right? So defensive strategies are like not so that stronger, right? So whereas anti-takeover strategies are very strong action that can be taken up by the target company, right? So what are those strategies that placed by the target company? So these are called as anti-takeover strategies. Let's look at here. So to name few, the anti-takeover strategies are like poison pill, Greenmail, people pill, white knight, recapitalization, share repurchase, golden parachute, crown jewel, Pac-Man, white square and shark repellent. Let's look at in detail each of this and try to understand under what different context that the target company will use these anti-takeover defense strategies. Fine. So let's look at the first one and try to understand it. That is anti-takeover defense strategy called as a poison pill, right? So poison pill is a kind of a strategy used by the target company to make the deal unattractive to the acquiring company. So this is majorly deals with the rights, right? The target company gives the rights to the shareholders, the existing shareholders' rights in the form of voting right, in the form of right to purchase the share, right? So that makes the deal very unattractive post when the acquiring company acquires for the shares of a target company. What is this all about? It is regarded as a shareholders' right plan. It is used to make the unattractive. Typically involves certain of securities that give the holder certain rights that become effective when a takeover is attempted. The pill allows shareholders to receive special voting rights or securities, right? So pill can be, this poison pill can be in the form of voting right, or they will be receiving the securities, right? So once it is been issued, causes the firm to be less desirable to the hostile acquirer, right? Either they have a right to buy the share, right, of an acquiring company, right? Once the shareholder has a right, right? So they have a right to buy the share at a price which is often a market price of a acquiring company. So hence this will make the deal to be very more cheaper. So here the different types of a poison pill that we come across here is first generation poison pill, where the rights is been or the shares are been issued in the form of like preference shares, right? So they give the preference shares. So once the target company gives the preference shares, over a period of time the preference shares get converted into the equity share, and when the acquiring company wants to buy the target company, right, the equity number of shares will increase, the volume increases, right, overall market capitalization value will increase for the target company, hence it will become an unattractive, becomes a very larger size. So hence preferential share, what happens, it will get converted into the equity share. The second generation poison pill, what we call as a flip over, that is right issue, right to buy the share, right? They will give the right to buy the share at a current market price. By this what happens, the existing shareholders will buy the share, use their right to buy the shares of any target company at the current market price, and it increases the volume, right? It increases the volume, it increases the size of the company. Larger the size, again it becomes very unattractive for an acquiring company. And the third generation poison pill is issue of shares at a very high discount to the existing shareholder, right? So issuing the shares at a very deep discount to the existing shareholders, right? So here what happens, again the target company will issue its company share at a very deep discount to the existing shareholders, which leads to increase in the volume, increase in the number of shares of the company, right? So by which what happens, the company will become a very larger the company, right? It would has to acquire the larger majority stake in the target company, then again it becomes a very costly deal for an acquiring firm. This is about like a poison pill. Then comes the other active takeover defense strategy are like Greenmail. So what is this Greenmail? Greenmail is nothing but is sending a email or in a mail by the target company to very prospective investor or to the shareholders of the target company. It's a strategy by which a firm repurchase or buyback through a private negotiation a large chunk of stake at a premium from one or the more shareholders. Right, so that what happens here, the target company will send a mail to the promoters or to the institutional investor who has purchased a larger proportion of the stake of a target company and asking them not to sell to the acquiring company and sell back the proportion of the share to the target company at a premium prices. Right, by this what happens, there is no proportion of shares is been left over for an acquiring company to go and acquire the share. If they want to have a controlling stake of more than 51%, right, so that 51% stake would not be available for an acquiring company, or it is not accessible because already the majority shareholders or the institutional shareholders has already sold to the target company and there is no shares available to buy from the market and control the ownership. Hence it becomes a very unattractive for an acquiring company. Such kind of a strategy what we call as a Greenmail strategy, or what we call as a goodbye kiss. Means goodbye, saying goodbye to the, that is acquiring company saying to the target company saying goodbye, because the deal is very costly and not having accessibility to control or to get the control of the company. The next strategy comes people pill. So what is this people? It is not about the external, it is about like internal, right? So the entire management team threatens to resign in the event of takeover. What happens when acquiring company wants to acquire the target company? So when the acquiring company looks, they not only looks the physical assets of the target company, they will also look for people, right? If you look at for IT knowledge based companies, right, so what they look at when they acquire is the talent or the experience, the strong management team, right? So majority in the case of like IT knowledge based firms, when the mergers takes place and the target company doesn't want to sell back the asset to the acquiring company, here what happens, the top level management, right, will threaten to the acquiring company saying that if you acquire the company, we all will resign. If all that strong team get resigned and leave the company, and the company is no more an attractive company, hence the acquiring company will lose the interest on the target company. This is what we call as a poison pill. The next strategy, that is anti-takeover strategy, what we call as a white knight. What is this white knight? White knight is a target company finds a more suitable acquirer. More suitable acquirer means as the target company is not willing to accept the offer of an acquiring company, then because of various reasons, because of cultural issues, right, because of mismanagement, because of agency theory, right, so not willing to sell the business to the acquiring company, rather the target company is willing to sell to the other company of that interest, right, where the culture match, where the interest matches, right, so where there is a look for synergy and the long term interest, there is a mutual exchange, right. So such company what we call as in a white knight. So target company itself will go and request for other companies to give a stronger bid, give a stronger competition to the acquiring company, and hence the acquiring company can lose the deal. That is what we call as in a white knight. Then comes recapitalization. So the company borrows a large, in this what happens, the company will borrow a large sum of money, right, and pay it off in the form of dividends, and this borrowed money would become a debt, right, and the liability onto the company, and hence it becomes a very costly for an acquiring company when they wanted to acquire, right. So they had to even take into the consideration the debt of a company, existing debt of a company, and becomes very costly, right, because it's not that worth, assets are not that attractive and the liabilities are been more. So hence they don't want to assume such liability and loses the interest over the target firm. The other strategy, what we call as a repurchase, is very simple. That is, target company, what they do is they will buy back the shares, its floating stocks. What is a floating stocks? Is nothing but like which are freely available in the market. That is with respect to any minority shareholders, right? So when you say large chunk, they can go for a white knight offer, right? Or it can be like a Greenmail for a majority shareholders or institutional investors. Whereas say for a minority shareholders, we can say the repurchase. They go to the market and buy back the shares from the market who is having less proportion or a smaller proportion, what we call as a minority proportion shareholders. Then comes golden parachute. This is also very famous or very popular anti-takeover defense strategy. Golden parachute, what is exactly this? Golden parachute is nothing but an employee contract of the key executives that provide them with a sizable compensation. So here what they try to do is they will try to give a different compensation plan to the executors, right, in the form of like ESOP plan, right? So yeah, it can be from ESOP plan or the different the different combination of equity and the compensation plans, right? So that makes executors or that offer makes for a acquiring company very costly, because they need to pay the compensation plan which has been executed by the target company to the management, right? So overall, suppose when you say ESOP plan, they had to issue the shares to the executors, right? Even when they acquire the company, even they had to pay, they had to acquire, had to compensate the employee stocks for the executors. That becomes very costly deal because the value increases, right? And it becomes very unattractive deal. Similarly, it can be a silver parachute. Silver parachute, similar plan. What golden parachute has been given for the top level management or top executives of the management. Similarly, silver parachute, similar plan can be given for the middle level management, and for the lower level management can also be given the plan what we call as a tin parachute, right? So tin parachute, the plan where the acquiring company wants to acquire, not only they had to acquire the ownership, they also had to compensate the employees with this plan. So then it becomes a very unattractive deal. Then comes the crown jewel. So what is this crown jewel? Crown jewel is like similar, let's take a conglomerate firm which has different units, right? Different brands, different products, right? So acquiring company is interested to acquire that whole of the business. So what they do is they will try to separate that unit itself and try to make as a separate legal entity, and that makes the deal for an acquiring company to very disinterest, because they wanted to buy this company because of that particular brand. If the brand itself has been sold, right, then it becomes a unattractive. If simple, you take the case of like Glaxo, right, they have sold only a one brand, not completely the brands of GlaxoSmithKline is been sold to HUL. What they have been done, they sold only the Horlicks and Boost to the HUL, right? They separated their brands and only sold this to the HUL, right? Now these are majorly the cash flows. These are going to generate a very high cash flows. When they try to remove such brands from the existing portfolio, then the company becomes very unattractive for acquiring. This is what happens in the case of like similarly in the crown jewel, right? Crown jewel is one brand or a product which is very attractive, right? It is been removed from the company's existing product category, then the whole company will become unattractive for an acquiring company, right? This is called as a crown jewel. White square, in this case what happens is white square, a target company looks for a third party. Similarly, what we look out for in a white knight, right? In a white knight, what happens when the white knight acquires the shares of a target company? He is interested in controlling the stake. He look for the ownership. He look for the involvement in the company's performance. Whereas a white square, what happens, the firm which acquires the shares of a target company and make the unattractive deal for an acquiring company, but he is not interested in the controlling stake, he is not interested in controlling the company of any target company. Such a type of a company, such a type of a takeover, what we call as a white square. Next comes Pac-Man defense. A Pac-Man defense is basically, this has been extracted from a gaming, that is video gaming, where a strategy where in a acquiring firms, when it makes the offer to the target firm, right? So here the target firm in return make an offer to the acquiring saying that I am interested to buy your company, say me what is the value. That is reversing the strategy. When acquiring company give a bid to a target company, in return the target company bids for an acquiring company. That is reversing back, bouncing back by the target company to the acquiring company saying that we are interested in acquiring, let me know what is your value. This is what we call as a Pac-Man defense strategy. Okay, so we'll stop here at this point of different anti-takeover strategies. So next class we'll discuss about like amendments. Fine, thank you.